For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, thank you so much. Welcome back to the program. It is Managing Your Financial Future, and I'm your podcast host, Johnny Dean, back here once again. Hey, we've been off for a couple of weeks doing our, it's not a hiatus, but in between seasons, we take a little bit of break and give Professor Plum a chance to do some actual work. Professor Rick Plum, certified financial planner professional, accredited wealth management advisor. In the 2 weeks we've been off, have you gotten any of those extra designations I talked about? Did you get any more, or are you stuck in those?
No, I was actually doing quite a bit of CE, continuing education, to maintain the credentials I already have.
That's what it is. Okay, yeah. Well, to maintain your make sure that the high quality of advice that we give on this program, maintains. We have a certain standard that we like to maintain on this particular show.
With all the time off I had from not doing this podcast for the last 2 weeks, I was able to, spend those, precious hours, fulfilling at least some of the necessary hours of CE that I have to do.
Yeah, continuing education. Well, that's good. And I imagine you educated a few people along the way yourself because of all of your experience. And we do know that experience counts, as it does in financial planning, as does keeping up with all the latest things that are going on. I mean, you can't be stuck way back in the past. Now, speaking of the past, here we go again with that segue. Let's see. It was in March sometime. We had a podcast episode which talked about what if you retire when the markets crash? And this is on people's minds right now. It was on people's minds in 2022. It has been
for a few weeks now.
It has been for, at least a week, a couple of weeks, or a few months. I don't know. But one of the things that you mentioned in that podcast, Professor Plum, was that I think it was a study that was done a while back. Was it a Hancock study or what?
I believe it was done by John Hancock.
Okay,
I don't have the reference to it right now.
Okay,
Sorry.
But anyway, that's okay. That's fine. Which had to do with retiring at a certain time, and if you retire at the wrong time. Now, we got a lot of folks asking us about this, and I said on that podcast that I recognize it can be hard to visualize what we're talking about when we talk about, well, can you retire now? And if the markets drop, what happens? There are some numbers in there, but I thought we would take this particular episode and maybe delve into it just a little bit more to try to make it more perhaps understandable. We did get a lot of mail from folks, emails and messages asking us to perhaps clarify that. So we're going to try to do that here and talk about, this goes back to the discussion on what we called sequence of returns risk. Not to keep hammering it, but this is such an important concept that people need to understand what it is we're talking about, to understand why we consider things like the bucket strategy to be so important to your retirement survival. So let's get into this, Professor Rick Plum, if you would. I called this, last time we talked about this was a couple of years ago when we did this sort of deep dive. I hate that term, but deep dive into it. Let's talk about this tale of two retirements, two different people. So we've set this up many times over the years. Can you please set it up for the folks now who are listening, and let's get into this.
Well, I want to step back just one piece. This study identifies the difference in the sequence of returns as fact of how it impacts an overall portfolio. But it also does another thing, and a lot of people look at their portfolio and they look at a mutual fund, a balanced fund or something of that nature, and they look at the average return it's achieved over the past X number of years. And they look at that and say, well, average, I got X, I should be able to do what I want to do and still end up with money. And so that's another portion of this. You can't, when you are taking distributions from a portfolio, you can't use the average rate of return that portfolio by itself achieves, because when they're doing averages, they assume no distributions, and distributions have a dramatic effect on your actual rate of return compared to the average rate of return of that individual portfolio. We'll get into that as we go as well. But we're looking at the sequence of returns. The returns that happen over the first 5 to 10 years of your distribution strategy have a dramatic effect on the viability of your strategy. A lot of people still prescribe to, in fact, one of the CEs that I was tuning into is the 60-40 portfolio dead?
I saw that. I said, boy, this is something that we need to talk. In fact, I think that was today's, was it not?
Yeah, I was listening to it today. Yes.
Yes. Okay. All right.
Yeah, but anyway, so I'm trying to broaden my horizons a little. No, anyway. So, but the idea that the returns that you achieve in the first 5 to 10 years of your distribution planning has a dramatic effect on the viability and where you end up. And so we're looking at this study, and as I said, I believe it's John Hancock. Sorry if I'm giving credit to the wrong place, but it took 2 individuals who are going to use the exact same strategy, exact same 50-50, not 60-40, but 50-50 balanced portfolio, 50% S&P 500, 50% Barclays bond aggregate. That's their portfolio, and every year they rebalance to maintain that 50-50 mix between stocks and bonds. They're just doing a balanced portfolio. They're going to do a 5% distribution each year at the beginning of each year. So in each case, they're going to start with $100,000. They're going to take $5,000 out each year, and they're going to see where the chips may fly.
Yeah.
But with a balanced portfolio.
Now
okay, right?
Yeah, and I'm sorry to interrupt, but what they're doing is taking a hypothetical individual with $100,000, and this is going back to the year 1969.
Right, and the difference between the 2 people is one of them did this in 1969, beginning of 1969, and one of them didn't start taking distributions till the beginning of 1979. At the beginning of each time period, though, they both started with $100,000 when they started their distributions.
Yes, so they started with this $100,000, and their idea was to take a 5%, is to take $5,000 every single year out of their portfolio. Beverly Hills Cop reference for those who understand that. Okay, $5,000 out of their portfolio each year. So, and when they finish,
they were going to live on that.
Yeah, they were going to live on that. And then whatever the balance was, they would rebalance their portfolio so that it's, again, 50% S&P 500, even though you can't invest directly in an index. But S&P 500, 50%, and 50% Barclays aggregate bond index. So I want to make sure people understand this is the setup where you're going with this. So go ahead, Professor Plum.
And so now I'm going to go back into average return. Now, if the person who started in 1969 with that 50-50 portfolio did not take any distributions from their portfolio, after 20 years, they had an average rate of return of about just shy of 9%.
Oh,
not a bad. And they're, over 20 years, their 100,000 grew into like $550,000. That sounds like that was a pretty good time horizon. I think they got quite a nice return over that period of time. Mm-hmm. But when you add in the issue of taking distributions, it changes things dramatically. And in the first 5 years of the distribution from 69 to 74, there were 2 negative years. One of them wasn't that bad. It was only down 2.6%. Well, that's not too bad, right? The 5th year, though, was down a little bit more. It was down 6.6%. But those were the 2 bad years in the first 5. Now, in the first 10, there were 4 bad years. Mm-hmm. Another one being another 2.4 at the end of period of time. The worst one being a 12.6 in the 6th year, negative 12.6. And the problem is when you're taking money out of a portfolio and you're experiencing down years, you have a big problem with your portfolio. Now, there were no down years in the second 10-year block of this individual.
From 1979 to 69, from 1979 to 1989, you're saying?
88, but yes,
or 88.
Through 88. Yeah. But so there was only those 4 out of the 20 that were bad, but they happened in the first 10 years. That person that started with $100,000, rebalanced annually to the 50-50 in the mix, took $5,000 a year out at the beginning. At the end of 20 years, instead of having, a big boatload, which is what they were hoping for, they were out of money. Zero, nada, zilch, done. They did not. It didn't matter what the return was going forward because they did not have any money. In fact, in the second half of that 10 year, the second block of 10 years, when from year 13, 14, 15, there was a plus 15, a plus 24, plus 17, plus 16. There were, plus 22. Those are all really good years. The problem is, by the time they got out to there, they didn't have enough money in there for that to make a difference. They'd already lost it and withdrawn it to live because they'd taken $50,000 out of the portfolio in the first 10, $5,000 a year. There wasn't any money there to experience that return. The returns in the first 10 years of the retirement dictated a failed strategy. Now, when they started this, they had no idea what the first 10 years are going to be like. And when you start your distribution strategy, when you start your retirement, you have absolutely no idea what the returns are going to be like for the next. You have no idea whether it's going to be a good set of 10 years or a bad set. And it has a dramatic effect. Like I said, after 20 years, this person using this particular strategy was completely out of money. Now, contrast that with somebody who retired at the beginning of the 79 period.
Yeah, so this is a second hypothetical situation. The first one, as you said, retired in 1969, took $5,000 a year out of what started to be a $100,000 portfolio. By the end of the 20 years, that person was out of money. Now we're taking the second hypothetical scenario, exact same withdrawals, everything exactly the same, except this person is retiring or beginning their distribution in 1979, not 1969. So go ahead, Professor Plum.
They're using the exact same strategy, 50-50 portfolio, the exact same mix, doing everything the same way, but they're going to experience a different set of results because the first 10 years of their strategy were all positive. Now, a couple of them weren't all that positive. 81 was only 3.5%. But still, they had positive returns over that. And at the end of 20 years, well, they were doing a little bit better. At the end of 20 years, they had $458,000 still in their portfolio. Now, this is completely ignoring taxes, but they had $458,000 in their portfolio instead of being broke. And after 30 years, they had $506,000 left.
It's still taking $5,000 a year.
Taking $5,000 a year out of it each and every year, all the way through life.
So on the one hand, if the person retired in 1969 and used that strategy, they were out of money in 20 years. If they retired in 1979 using the exact same strategy, they had, after 20 years, what did you say again?
After 20 years in 1998, the end of 98, they had $592,000 in change left over.
Versus being broke if you'd retired 10 years earlier.
Now, the curious thing is, looking out 30 years, or is that 40 years? 79 to 08, 30 years. At the end of 20 years, they had $592,094. They continued to take $5,000 a year out. What's that, 1%?
Yeah, of 500,000.
Less than 1%. Mm-hmm. At the end of 30 years, 10 years later, you know what their ending portfolio was with that same portfolio? $591,000. They were only taking 1% out, and they ended up at the same place that they started with 10 years earlier, because that block of years was the 2000 time horizon, where the S&P went nowhere and bonds didn't do that well.
But they weren't wiped out.
It's all a matter of what are the returns going to be in the next 10 years. So the person that started in 69, they doing a balanced portfolio had no chance in the way it turned out. Person that started in 1979, they could have used almost any strategy. They would have been fine.
Well, and it comes down right there, Professor Plum, to just the luck of the draw. I mean, whatever the first 5, 6, 7, 8 years of returns are, if you happen to get a good cycle, lucky cycle, I would say, then you're probably going to be okay. But if you get on a bad cycle, you are likely going to run out of money. And this is why we talk about this.
But I'm going to say something to that. The answer is yes and no. You do have control over this, because the strategy was the same in both of these and yielded very different results. The strategy was what the problem was. Mm-hmm. They did not have the correct strategy. Anytime you're taking money out of a portfolio when it's going down is a bad time. Now, it really hurt the person that started in 69, but it didn't help the person who started in 79 in the last 10 years of their 30-year time horizon. Mm-hmm. It didn't help them at all. So having a more appropriate strategy, I think, can alleviate a lot of fears. Now, one of the problems that the person that retired in 1969 and started taking money out was they probably did not let themselves go broke after 20 years because they stopped spending money. They cut back everything. And unfortunately, they lived with the anxiety and they lived with stress of money. And so that is a problem in itself. In your retirement, that is not something we want to do. We want to, as much as possible, live as stress-free as possible because it helps our health. And health is a big important issue. So what I did with this study, though, is I took it one step further. I said, well, let's take exactly this portfolio, but let's apply a better strategy to it.
You mean to both, really?
To everything, the whole thing.
Let's start then with the strategy. I'm going to guess you applied a bucket strategy to this.
I applied an overly simplistic, but yes, a bucket strategy to this. And by definition, I'm becoming more conservative. I think most people would agree. Of the 100,000 that the person in 1969 was starting with, instead of putting it all in a portfolio that's a 50-50 mix, we're going to put half of it into a portfolio that's the 50-50 mix. Why half? Because I want to take $5,000 a year distribution for the next 10 years and not have to worry about it. So I'm going to take $50,000, 5,000 times 10, and put it into the mattress, a pillowcase, a coffee can, something that earns nothing.
Figuratively speaking.
Nada, zilch.
I'm saying figuratively speaking, you wouldn't actually put 50,000 in a coffee can. But meaning you're not going to
exaggerate.
You're not going to earn anything.
You could earn, decent interest on a bank account, but I'm saying you didn't even do that. You just put, your 50,000 into something that earned nothing, but was safe, did not lose a dime. Nobody stole it from you. You didn't, and it had no market risk. And you took $5,000 out of it each year. So you have the exact same cash flow that you did if you did it all in the market. And then 10 years goes by, and you're out of coffee can money. You take $50,000 out of the investment portfolio that was left in that 50-50 portfolio, and you put it back in the coffee can and draw another $5,000 out every year for the next 10 years.
Now, how much is in there? You've emptied your coffee can, but your money was there no matter what. How much after 10 years was in the investment portion, which you said you did half S&P 500, half Barclays bond?
At the end of 10 years, I had $78,000 in the 50,000, even though it had 4 negative years in the first 10. Had grown from $50,000 to $79,000, almost $79,000. So I pulled $50,000 out of it and left the rest to grow.
Okay, so now you've got another $29,000, but you've got 10 more years of $5,000.
Before I need to touch it again.
Yeah.
After 10 years, when I took the more aggressive all in the portfolio approach, the individual was zeroed out, had no money left after 10 years. If you did the more, what I would call more conservative, because you put half of it in a very safe, no-risk situation and drew it down, you had $102,000 left over at the end of 20 years. Using the exact same portfolio that you did the first time, but only using half of the portfolio, using half safe other money. So it basically, like I said, you're being more conservative and you ended up with more money. Instead of being broke after 20 years, you had $102,326 left over after 20 years. Now, you're not ultra rich, you're not ultra wealthy, but you're no worse off than when you started, and you still have money left over.
Yeah, and so what you've done is you've at least stopped somebody from running out of money using this strategy.
And then if we did it again, pulled 50,000 out of the 102, 103, put it in the safety area, and pulled 5,000 a year after 30 years, we started with 100. We end up with $189,500. That's my legacy to my kids. I never went broke. I took $5,000 a year out, and I left $189,000. And I didn't run out of money in 20 years. And I'm experiencing the exact same market conditions I'm just using them differently.
And by the way, you weren't watching your account dwindle down with this $5,000 that you took out every single year.
I didn't have as much stress. I didn't have as much financial anxiety. I didn't worry that I had to cut back my spending because I was going to go broke. I could, do the things in retirement that I'd planned on doing with the $5,000 that I'd planned on doing it with. Now, what I thought about that when I first did this, I thought, well, this has got to come at a big cost. Because if it had that dramatic of an effect on somebody who retired in 69, it must also have had a dramatic effect on somebody who retired in 1979. But this time it would have been a negative effect. And so I did the exact same thing for that person that retired in 1979, taking the $5,000 out. I took half of the portfolio and put it into safety, pulled the $5,000 out. Where was I at the end of the 20-year period of time and at the end of the 30-year period of time? At the end of the 20-year period of time, where the portfolio, let me grab the right paper here, hold on. Where the portfolio had $592,000, well, we were only at $458,000. So we were, $140,000 difference, give or take. So that's it. Well, we did not have as big of a legacy, but at the end of 30 years, we had, instead of having $591,000, we had $507,000. Okay, yeah, we gave up some upside. We gave up that difference in upside from 506, 507 to 591. We gave up that upside to make sure we didn't go broke.
Well, you gave up some upside to give yourself some
we
measure.
We gave up upside in the very, very good years to take away a bunch of downside in the bad years.
Yeah, which in that 1979 example, after 30 years, we had real bad 2000 to 2002, and then of course we know what happened, 2007, 2008, which had an effect on that. So it really, Professor, what it comes down to is, of course, strategy.
Yep. Strategy is more important in this case than the investment selection on that.
Yes, and you made an important point that if you're experiencing nothing but up markets for 20 years.
Or anything works for the most part.
I mean, yes, and you put all your money and let it ride in the, even though you're taking distributions, and you just let it go, 50-50 stock bond. I mean, you are going to ride a wave up, and you're probably going to do somewhat better at the end, but you're not going to do dramatically better in the end than if you had. In this
particular 30-year case, we didn't do dramatically better.
Yeah, well, then if you had bucketized that particular portfolio. But the problem is you don't obviously know what the next, forget the next 10 years, what the next 2 years.
What returns we're going to have in the next year, 2, 3, 4, 5. And going back to the original, the sequence of returns has a dramatic effect on the viability of your strategy.
It's such an important thing, Professor Plum. I don't know why this isn't talked about more. I don't know why when somebody is sitting across from a client, a financial advisor, and they're saying, well, we'll just, we'll do our 60-40 mix or whatever it is, and we will chop off a certain amount, give you this for your income, and then we'll just rebalance. I don't know. I mean, that's a lot of risk, in my opinion. There's potential reward if markets cooperate, but as we're seeing now, I mean, anything could happen.
And who knows what the next event, bombshell, whatever is going to be out there that roils the market.
Well,
or goes the other way.
It's interesting. We're the day we're recording this, I just saw S&P. And it doesn't matter the date, but S&P on this particular day recorded its worst day since 2020. Now, we remember 2020 had some really bad, especially in the early part of that. But who would have foreseen this 6 months ago? No one. And who's going to foresee the next event? And how long will this kind of thing last? So this is the kind of stuff that I think when you think about retirement and you think about strategy, if a financial advisor is not taking into account somebody's psyche during retirement, somebody's level of fear as they take a look at their portfolio and watch it go down, then they're not really doing their job, in my opinion. And I think you would agree with that because you've sat across the desk from many, many people over the years.
And financial stress is a reality. Even when things are going well, it's a matter of, when are they going to turn against me? Some people have that look at it too. So if we can put a strategy together that takes the guesswork of having to be right on what's going to happen next year out of the equation and know that they still have the cash flow that they need for the next 5, 10, 15 years, life is a little bit more stress-free. Or it's not stress-free, but that portion of your life doesn't have as much anxiety.
Yeah,
which is nice.
If you think about it, if you just think about it kind of in a zoomed out mode, if you have the income that you need to get by for the next 2, 3, 4, 5, 6, 7 years, where you know you really don't have to worry about it so much, yeah, you may not like to see the stock portion of your portfolio take a hit, but it's not life-altering in most cases. Now, I get it, and you've seen this too. There are people who just don't want... I don't care if I never need the money, I don't want my portfolio to go down, and that's fine.
Oh, yeah, I've met those people, yes.
Maybe they're saving it for their kids, which...
No, it's more for them. It's a matter of, I'd like to leave something for my kids, but I've had one individual say, I do not want to ever see a negative number. I know that I don't need the money. I know that I just can't handle losing a dollar. And so they don't want to do that. So their portfolio is structured differently than somebody who has different goals.
Yeah, and I can understand that too. This is why this is why when I used to go to Las Vegas years ago, I couldn't gamble. If I lost $10, that's it. I guess if I stayed long enough, maybe I'll make something, but it's just the very thought of losing anything would get to me. So, but this again, you have to take into account people's fears, people's goals, and all that other stuff. And if somebody tells you as a financial advisor, I don't want to lose any money, well, then Professor Plum, you structure a portfolio to reflect that and to counteract that so that they're not sitting there worried every day.
There are investments that allow you to have a principal guarantee by a big bank or something that then also allows you to have a participation result. You're not actually in, but you get a result as if you were participating in the S&P or some basket of stocks. And so they're usually 2 to 3 year or more notes or something of that nature that you say, over that 3 year period of time, if the market is 0 or negative, you don't lose anything.
Mm-hmm. Yeah.
If the market is 0.01 or better, you get 120% of whatever the market did, or some number, some multiple on the top side. So you can't lose any money, but you can make some money. Now, for some people, that's a very attractive issue. There's also other ones that give you different dynamics, and there's all kinds of strings, iterations of these. But there are ways to still invest without risk. Obviously, though, your upside potential is going to be limited compared to things that have volatility, have risk.
And we've talked many times about why risk is not volatility and why you need to manage risk, because you really can't do anything about the volatility. It's called the bucket strategy that we just described right here. If you'd like more information on this stuff, I should say, first of all, that we have a similar illustration, not this one, but a similar illustration in the bucket strategy guide, which you can download for free, of course, over at luciacap.com, LUCIACAP.com. Type bucket strategy in the search bar at the top right, and then it should be the first thing that comes up. You can download it and view it, understand, and you can see the numbers for yourself, exactly what it is that we're talking about, why your sequence of returns matters, and what you can potentially do about that. And it all comes down to strategy. As I said, the bucket strategy. So type in bucket strategy. You can download your own guide. Got a bunch of other guides there, too, on things that we talk about, Professor Plum. We've got a Social Security guide. We've got a estate planning guide, a couple others, retirement income guide, and all that kind of stuff. All there at luciacap.com. You can find it by typing that into the search bar. So I hope that clears it up for people who had asked us about that. And then now by the time this episode airs, it'll probably be another 4 or 5 weeks, and then we'll get questions about this. But if you do have questions and you want us to clear anything up, explain something, please do so. Go to luciacap.com and send us an email. You can talk to Professor Rick Plum or any of the Lucia Capital Group advisors. Give them a call at 800-644-1150, 800-644-1150. They can help you out with the bucket strategy. They can explain it to you and tell you, well, here's why we take care of risk before anything else. This is what we do. It's all about strategy. Strategy first. 800-644-1150. I hope this podcast is informative and entertaining for you. If you find it that way, you can certainly subscribe at Apple Podcasts or Spotify, either one. Find us there and download every episode to your device. Listen every single week. And I really hope you learned something and that you find it entertaining as well. It's always fun, Professor Plum, when you strike a note with somebody, when you're talking about something like finances or planning and all that stuff. I'm sure you've seen this when you're talking to somebody and kind of the light bulb goes off and they say, oh, okay, I get it now. That's kind of nice, isn't it?
Oh, it's very nice. And in the wake of these, the turbulent times that we've been going through a little bit, when we're talking with people, they're like, yeah, it sounds crazy, but I'm not too worried because I know I've got a strategy that gives me time to not have to sell when things are down and time to recover with the assets that are in the volatility area.
What better way to go? Professor, thank you so much. I appreciate it as always.
Welcome.
Talk to you again next time. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks so much for listening. We will, of course, talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including the potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. An investment may not be made directly in an index. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies and leading industries. Barclays Aggregate Bond Index is an index commonly used as a benchmark by both passive and active investors to measure portfolio performance relative to the U.S. dollar-denominated investment-grade, fixed-grade taxable bond market. It is also an informational measure of broad market returns commonly applied to fixed income instruments. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.